Hello there, my name's Miles Pitcher. I'm the owner of Superior Lending. I'm a mortgage broker, and today we're chatting about FHA Streamlines. And as we see our interest rates starting to fall and drop, this is an incredible option for those who are in FHA loans to be able to drop their monthly payment and save a ton of money in interest and just over the life of the loan. So let's get started here. Let's go right here. So first of all, what is a streamline? Streamlines are available on any government loans. That means FHA, VA, USDA loans. We're focusing on FHA today, but I can guide you through on VA and USDA also. They have different names. Like a VA is called an EARL, an interest rate reduction loan. But it is a really slick way. It's an easy loan. If you felt like you were providing a ton of info on qualifying to get your first FHA loan, the Streamline is just opposite in that they totally make the process streamlined and easy for you to get done. But we're going to go through a lot of details on it. There are so many details here that you may think this is not easy, but that's where a qualified and expert loan officer will make this very easy for you. All right, so first and foremost, the advantages is there is no appraisal required again. So even if your home has gone down in value, you can do a streamline. You get to lower your interest rate, and the paperwork and qualifying is super duper easy. I love this one. You can add or remove borrowers. Maybe you had a cosigner when you bought your home and you want to get that cosigner off. There are some extra rules on doing that, adding or removing, and I'm not going to go into all the details on those today. Give me a call. I can help guide you through the adding and removing. I love this one, condos. If you are in a condo that was FHA approved and maybe the HOA has not kept up their condo approval and it's expired, you can still do an FHA streamline. Another awesome one is the ability that if maybe you bought your home with an FHA loan, you've lived in it for a year, and then you went and bought a new primary and converted the old one to a rental, you can still do an FHA streamline on that investment property. It's awesome. Closing costs, we'll talk more about those, but this type of loan really minimizes the closing costs to you as a borrower. Some of the disadvantages, and there are very few, is that you start your loan amortization or the 30 years over again. But the monthly payment you save may make it worth it. You have to pay the upfront mortgage insurance premium again. We'll dive into that. So we're going to revisit that in a second and show you how we offset that. So to qualify, number one, you have to be in an FHA loan currently, FHA to FHA. You have to have made 6 payments on your mortgage, and there has to have been 210 days having passed since you closed on your last FHA mortgage. Maybe that was the purchase, or maybe you did a refinance, but you need 210 days. If you have gone out and assumed an FHA loan, and I have a great video on assuming FHA loans, I'll put a link up at the top. You have to have made 6 payments after the assumption has been completed. So speaking of the subject property or the one we're refinancing, you have to have no lates for the prior 6 months, and you can't have no more than 1 30-day late in the last 6 months on all the properties you own. You need to be up to date and current on your payments. This is very cool about it, is we get you verified with a mortgage-only credit report. So we just pull that, and it just shows that you've been on time on your mortgage payments. So I mentioned the upfront mortgage insurance premium. At the time of this video, it's at 1.75%, and that is charged and rolled into your loan. You paid that when you got or purchased your home or did your last refinance. The very cool thing is that you get every single month you use up a portion of that premium, and the unused portion is given back to you as a credit or an offset against this new upfront charge. So let's take a look here. So I know this chart's small. Let's go bigger here. It shows you the months here. And so let's assume that you originally paid $2,500 on a loan that closed 10 months ago. If you look at the chart, you'll be able to see that 62% of that is refundable, or in other words, 1,550. So that 1,550 will show as a credit against your new upfront mortgage insurance premium when you do the streamline refinance. So that really helps to offset that charge. And by the way, I want to remind you that the upfront mortgage insurance premium is not paid at closing by you. It is always rolled into your loan. Okay, we've talked about the upfront, but then we also have the monthly mortgage insurance premium. And I want to remind you about this because this will factor into what I'm going to show you next. So March 20th, 2023, HUD or FHA reduced the monthly mortgage insurance premium. Prior to that, it was at a 0.85, and now it's at a 0.55. We call it basis points or factor. Okay. Nice move, nice savings. So if you closed your FHA loan prior to March 20th, 2023, you're paying a higher mortgage insurance premium monthly than those who have recently closed. Why does this matter? Let me show you. Because when you do an FHA streamline, in order to do one, you also have to prove that you're saving money. In the past, before this was in play, people could churn loans, and loan officers would convince people to do a refinance just to collect fees, and there was really no benefit to the borrower. So now there are rules in place to make sure that the borrower is being benefited. So think about it this way, and I'll take you through an example in a second. Your current loan, you take the original interest rate plus what you're paying in monthly mortgage insurance premium, and then you take what the new refinance would be rate plus the new monthly mortgage insurance amount, which is going to be like around 0.55, and you have to have saved the client 0.5%. So let's look at an example. So here's a little calculator that we have. So our original client had their interest rate at 6.25. They closed this a long time, say over a year ago. So they're paying that 0.85 in the mortgage insurance premium. Okay. It is a fixed rate loan we're doing, and tangible benefit factor. That's how much I have to save this client. So once I factor that in, along with what the new mortgage insurance premium factor is, the maximum rate is 6.05, meaning I have to give that client either a 6.05 or lower rate for this loan to be approved and the streamline to be able to happen. Okay. How much does that save the client monthly? Well, that all depends on how much their loan amount is. But as you are evaluating this, just think in your mind, hey, our interest rate's roughly 0.375 to 0.5% better than where my current rate is. If they are, we need to look and see if we can do a streamline for you. Okay, now what about closing costs? This is one of the benefits to a client on closing costs. They limit what you can roll into your loan. Upfront mortgage insurance premium, we've talked about, that gets added to the current balance. And remember, there may be a refund, and so that benefits you there. We are able to roll in any interest that you have due on the loan and the monthly mortgage insurance premium for the next month. Well, what about the rest of the closing costs, right? Because there's still underwriting fees, there's title fees, and there's also setting up your new escrow account. Well, they have to be dealt with in one of two ways, or a combination. Number one, the lender gives you a credit to cover the closing costs, or the borrower brings in cash to close. Okay, with that happening, I like to structure it a certain way that helps really benefit the client. I also want to remind you that if you have an escrow account or prepaids or an impound account, the names are interchangeable. That's the account that pays your homeowners insurance and property taxes. Any amount in that account is going to also get refunded back to you in the next few weeks after you close the streamline refinance. But we love strategizing with our clients, helping them to minimize the cost using a lender credit to cover the closing costs of doing a streamline refinance. Now, here's a list of documents needed. They're very, very simple. Complete a loan application. I'll put the link to my loan application in the notes here. And then also, we just need to know who your homeowner's insurance is through, the company, the agent, 1 month of bank statements. We need something to verify your address. So that can be like a pay stub or utility bill. We need driver's license or passports for a valid ID. And then this one, if it's hard to find, we can help our clients find these, but we need a copy of the deed of trust of the current loan or the note you signed at closing. Why do we need that? That helps us to understand where your current rate is and how much you're paying in your current mortgage insurance premium. By the way, if we are removing or adding another borrower, there will be additional docs needed. Okay, frequently asked questions. Should I refinance into a conventional loan or should I do a streamline FHA? Well, a lot of things depend on that. One of the things I would say to this is, number one, only go conventional if your credit score is 700 plus, and if you have at least 20% equity in the home. If you go to conventional, it's a full qualifying refinance. It's not a streamline, and you will have to do an appraisal, and you will have to fully qualify with all your income. So if your income is dropped or your home value is dropped, a streamline refinance is for you. Or if you just want something easy and quick, the streamline is for you. Just keep in mind, you do a streamline refinance, you're still going to be paying that monthly mortgage insurance premium, but the interest rates are usually really, really good. Do I have to income qualify again for a streamline? Nope, you don't. Can you get any cash out on a streamline refinance? Only up to $500. Do we do a credit check? All we do is that mortgage credit verification. Okay. So we're really not even doing a credit check on you. Okay. There are two versions, a credit qualifying and a non-credit qualifying streamline. Here's how you can get a hold of me. My name's Miles Pitcher, and you can reach out to me and my team. We're always happy to get you numbers and see if this makes sense. Have a good one.